know that all the dealers out here are really good at that, and we might not be as excited about financial statements and accounting, at least as we are up here. So we're going to give you some tips, guidance, and best practices to help with the financial statements to do that moving forward. So my name is Bryan, I'm with LHPH, and today I've got two industry experts as well, our own Kelly McKinney and JP as well from Bryan Consulting. And Kelly was born and raised in South Louisiana and currently lives in Virginia. Her career in risk management started after completing her MBA in 2000. And she also enjoys spending time with family and friends, as well as watching football and a lot of other sports. And Kelly, can you take a minute to tell us about yourself?
Welcome, everybody. I know I've talked to a lot of you over the course of the past year or so. Most of you know that working in Virginia for a company in San Diego, I get a lot of you first thing in the morning. You get to call me at 9 o'clock Eastern, and I answer the phone like bright-eyed and all ready to go. But I spent my entire career so far in commercial lending, so lending to small and medium-sized businesses, but specifically on the credit risk side. So as you know, Trevor from Business Development and Tim, they have that sales skill that a lot of you have that I don't possess as strongly. So I started off in early 2000, and I was lending to new car franchises. So I learned all about floor plan. I learned about building brand new Honda facilities or brand new Infiniti facilities and what the manufacturers were costed. I learned a lot about dealer accounting, which is my sarcastic way of saying dealers have their own accounting, and then you have GAAP and you have tax returns and stuff. In about 2006 or so, I transitioned at Capital One. I spent 18 years at Capital One. I transitioned into specialty finance. And so the way I would explain it to you is if there was an end consumer at the end of the note, whether it was an auto loan or a vacuum cleaner loan, or it was furniture and fixtures, or it wasn't a mortgage, but it was anything with the consumer, specifically subprime consumers at the end of the note. I've had experience lending to those fintechs. So your buy payers, your LHPHs, your indirect autos, your indirect furniture companies, your buy your paper furniture companies are fun. So anything that had a subprime consumer or had that paper, I've been around for at least the last 12, 15 years, I've been around that paper. I started with LHPH about 18 months ago, so I'm going to be here for risk mitigation. But I do everything from your credit risk, so the approvals that we do for innovation renewals, any increases that you can do if you do store openings that you're doing. I'm in charge of all those approvals, the underwriting. We have a team of people in risk. But on the other side, I'm also part of our team for our operational risks, our cyber risk. So I'm looking at risk holistically for LHPH Capital. But most of you are going to see me day to day because I'm working on, a line increase, or I'm working on changing something in your loan agreements, or we're looking at approving something for obligations.
Thank you so much, Kelly. So Kelly has some great experience, and I'm excited to hear more about what it looks like from her perspective as a lender. And then we also have JP Bryan with us, and JP is with Bryan Consulting. JP was born, raised, and currently resides in Indiana. He started in the accounting industry in 2008, and he also enjoys spending time with family and friends, playing and following sports, and finding great craft gear. So JP, can you tell us a little bit about yourself, please?
Yeah, thank you, Murray. And I realize I'm sitting in front of a really cool guitar. I saw that earlier from the crowd. I'm not a rock star, I'm just a humble accountant who doesn't know how to apply sunscreens. So we'll start there. Thanks to Tim and the rest of the LHPH team for putting on an awesome conference and letting me be a part of it. There's a lot of successful dealers out here and a lot of brain power in this room. I hope to add a shred of value and think of the world of the way LHPH partners with dealers all along the way. And so you got a little bit of my background, but I've spent the last 13 years up until recently in public accounting as a CPA, serving this space as well as others, doing auditing and accounting work. And similarly, our original founder, maybe our senior founder, Chad Martin, raise your hand over there, buddy. Many of you probably know already. He was also in public accounting for a handful of years before he went to the private world as a CFO and controller of a variety of businesses. And 7 of those years were with large dealers like yourselves. And so he started serving a dealer on the side in this room, I believe. And that quickly, as an outsourced CFO, and that quickly became 2, and then 3, and you realize there's such a need for accounting expertise in this space that he started our practice. He grew from there, we got to know one another and joined forces earlier this year. And so maybe just a little more context on what is an outsourced CFO, what's a fractional CFO? And so generally what someone in our shoes would do is kind of come alongside the business as an extension of management to kind of provide that high-level CFO financial expertise at a fraction of the cost and time. And so, that might mean, it looks different for everyone depending on the need, but it might mean, accounting team build out and oversight policies and procedures, monthly close support, producing those monthly financial statements, budgeting and forecasting and monitoring those against actual results, helping out with monthly bank reporting compliance and capital and finance raises, audit and tax kind of support. So a variety of things, but just wanted to offer that up in context. So.
Yeah, thank you so much, JP. So I want to encourage the audience as we go through to make sure that you all are getting value. We're going to have time at the end of each slide where you can jump and ask questions. So certainly do that so you can get value out of it too. And I think between JP and Kelly, we have some great experience. We have public experience, we have dealership preparation, and we have lender experience. So I'm excited to dive in. So why don't we go ahead and do that? We'll move to the next slide and start going through some of these questions that we picked out for you. So JP and Kelly, can you tell me a little bit about what financial statements are produced by the dealers and what information they contain?
Absolutely. Thanks, Murray. And so I recognize there are dealers of all shapes and sizes and experience levels in this room, but we're going to kind of start basic here. And so the core statements that you want to get to a place where you're producing on a monthly basis are going to be your balance sheet and your income statement, also known as your P&L, which I'll refer to it as the P&L. And so we're going to start with the P&L. It's a bit easier to come by for most who are a little bit more concerned with whether or not they're making money than what their assets and liabilities might be. And so kind of following maybe the handout you have in front of you or on screen here, what I did the other day before I was scrambling to get out of town was cobble together a balance sheet P&L for a kind of 600 account dealer and do both the lease year, pay year, and buy year, pay year equivalent. And so you should have access to that. So we're going to start with the P&L, and really what your P&L shows is over a period of time, it's giving you your revenues, your expenses, and as a result, your net income or loss. Pretty straightforward. And when I talk about revenue, I'm talking about things focusing on the lease year, pay year dealer, doing the operating lease. I'm talking about things like your rental collection revenue, your down payment income. Those are going into this lease income line. But I'm also talking about true sales from things like retail, residual, or wholesale. On the cost of goods sold side, which is the next line down, we're going to have the cost reported for any of those true sales from retail, residual, or wholesale. But here's our first big distinction, right, from the buy here, pay here, to lease here, pay here dealer doing the operating lease. When we send a vehicle out into a new lease, I know it's common around a dealership to say, you just bought a car, we just sold a car. Well, technically for book and tax, there's no sale. You simply retain ownership of that vehicle, move it from inventory on lot to lease inventory or leasing assets, leasing vehicles, something like that, and collect rental revenue and depreciate it over time. But on the buy here, pay here side, we trigger that sale, that cost of sale, and that gross profit right up front. And so to follow from there is really going to be a catch-all for the rest of our operating expenses. Your people expenses, your rent, your utilities, anything else really. Interest expense on debt is all going to go there. But then comes that second distinction from buy here, pay here to lease here, pay here is, on the buy here, pay here side, we're recording that bad debt expense for, the principal charge off on any of our notes. Well, we don't have that in that manner, I guess, for leasing. Instead, we're going to recognize our depreciation expense. And so this is a big one often missed or miscalculated by lease year pay operations, this is a required form of GAAP we're going to talk about in a second. When you retain ownership of an asset, you depreciate it. And so a quick example might be, for book purposes, you buy and fix up a 2015 Camry, you're all in 10 grand, which I don't know, that could be a little bit low these days. And so it's January 1st, you send it out into a lease, and you might decide that vehicle has 5 years left of life. Well, by December 31st, you will have taken 1/5 of that vehicle's value, or 2 grand as depreciation expense. It hits your P&L. And so that goes across all vehicles that are out on the lease throughout the whole year. And so then the net of your revenues and expenses is just going to be your net income or loss for a period. And so what I'm alluding to with things like depreciation is when you're reporting your financials to an outside party like LHPH, or you go under audit, you're required to report them under GAAP basis accounting, generally accepted accounting principles, or accrual basis, you hear that term used. And that differs from cash basis, right? And so it requires you to record revenues as they're earned and expenses as they're incurred. Depreciation is a form of this accrual basis accounting. Another one that I think is a good example to think about is property taxes, right? So we're all levy tax on the vehicles that in many jurisdictions is levied one year but due the next. Well, GAAP basis accounting requires that we hit our P&L in the year in which that tax is levied, because that's when it's incurred, even though the cash doesn't leave the business until next year.
So I'm going to interject for a second. The reason that depreciation is the topic that we're bringing up for a second here is that when you're looking at your actual physical federal tax return or your state tax return, that depreciation number is going to be based on tax code, and you're able to do a little bit more in the tax code than you can from a GAAP standpoint. So if you're looking at things like, so when I look at, and I'm going to jump to the question here, when I look at what we get monthly, like I'm getting financial statements monthly, but I'm also getting a tax return through the year from our dealers or from Prospects, and I'm looking at how you're depreciating the tax, but from a purpose of the amount of money I can lend out or the repayment analysis or so, we're looking at your book. So we're looking at what is GAAP or what is CPA on a compiled financial statement, which in most cases can be GAAP, but can also be a tax-based statement. But the reason that when JP, we did this fundamental, this is book. So if you bring this back and hand it to your CPA bookkeeper, so it's book. This isn't necessarily what will be reflected on this fictitious dealer's tax return. So just keeping those things in mind, it's something that we do look at. So at LHPH, I'm looking at both, and I'm not making decisions on both cases, but they come together. So if you're producing your own management financials out of DMSs or out of QuickBooks or so, knowing how you're depreciating for your book is important as it is what your tax accountant is going to do with your tax return. But they're not necessarily going to be the same exact number year over year. The other thing, as JP mentioned, is when you move it into your lease inventory, and you actually have this operating lease depreciating, that in itself is your fixed asset. So you are in control of that fixed asset versus by your figure where that asset is now owned with a contract with that consumer. So you get a lot of those when we talk about the tax advantages. That's one of those advantages. And you're looking at the life of the asset. How long is the car going to last for your depreciation? And they can all change. Every dealer in here can do depreciation completely different than each other. There are common practices. There are guidelines that I know DealPack or AFS or so may recommend, but depreciation itself is specific to how you want to depreciate the cars and actually the life of that car, depending on what you're paying for and how many times you might go recycle it.
Yeah, so Kelly, I'm just going to jump in really quick since you mentioned depreciation and you said you can take a little extra depreciation for tax purposes. But just to make it very simple and clear, why is it helpful to take extra depreciation for tax purposes, and what is the benefit of that for you?
Yeah, good question. So right out of the gate this morning when Tim was talking about some of the advantages we utilize, and the big one right now, the TCJA is under the the Trump administration put out was bonus depreciation, right? And so if you're a lease or pay your dealer in this room doing an operating lease, my guess is you have paid less in taxes the last few years than you otherwise would have with the amount of book profit you were showing. And so this bonus depreciation allows us to take 100% of a vehicle's value as a bonus expense deduction against our taxes in the year in which we put it out into a lease the first time, not for a recycled vehicle. And so that's what we're all generally electing right now. Everybody's tax strategy is slightly different, but we're probably using that right now. And so, you know, our book example here, our Camry was $2,000 of expense against our books, but in our tax return, that's probably $10,000 right now. And so in 2023 is when this favorable position starts to taper off, and sunset they call it, and our 100% is going to go to 80% the year after, and then to 60, and so on and so forth as it heads towards zero. You know, fortunately, Joe, thank you for bringing this up yesterday because I wasn't thinking about it. We aren't necessarily going to have to be lobbyists to potentially return some of those favorable bonus depreciation rules as they begin to sunset, because the Caterpillars of the world, who are, you know, heavy equipment carriers, are going to be doing some of that themselves. But
just real quick, do
yeah.
you know if the Biden's tax proposals change that number, that 2020 sunset number? You know,
it hasn't been changed right now. No, I don't think he'll be in a hurry to extend that. So.
But I think we have enough lobbyists, though, that the leasing industry itself, that's going to go in ways for now. So I think some of the associations, but I think a lot of the leasing companies, like you mentioned, the Caterpillars and stuff that are heavy in this, they're going to make strong arguments that we're going to benefit from.
But I also don't think we can count on it, and I wanted to talk about this, and if I can continue down this rabbit hole, because we might not have time for this later. I think we all need to be long-term tax planners and plan for the worst, because there will be that day when bonus is tapering off, when we're chewing through any loss carryforwards, you know, that we have banked, that we need to have a plan to cut that check for hundreds of thousands, or make alternative plans. And we've all getting a little fat on some of these programs right now. But start strategizing a little bit on when your tax bill could hit, and maybe that's not the year to open a new location, because that's a cash crunch as well, or I don't know, maybe we don't take bonus every year and bite the bullet a little bit along the way. It's an individual conversation, but I want people to start thinking about it now and kind of plan for the worst in the years to come.
Awesome. Well, thank you for touching on that, JP. And I know I interrupted you, so we went through the P&L. Would you mind going through the balance sheet as well?
Absolutely. So also on screen and on the other side of your handout, it is your balance sheet, just a fictitious one, maybe a 600 account dealer here. Something I slept on this, looked at again, but it had already been printed out. A 600 account dealer with a finance equivalent of $4 million for 600 accounts is a little low, so ignore that, pretend it's a little higher. But anywho, so at any given point in time, your balance sheet is going to show you a snapshot of the assets the business owns, the liabilities that it owes to other parties, and as a result, equity in the business. And so when I'm talking about assets, we're going to measure and report, you know, your cash, which should be reconciled to the bank account, and hopefully we're doing that on a near daily basis, right? I'm talking about things like, you know, your inventory on lot, right? Your purchase price plus recon, maybe auction fees, maybe GPS, any other fees you capture in that number. We're talking about, for a lease or pay your dealer doing this operating lease, the leased vehicle inventory. And so, you know, we send that vehicle out onto the road, and day one, it's not a sale, right? We're just moving it from that inventory on lot to this leased vehicle account, where it then begins depreciating, right? And we've got.
Are you doing it one for one, or do you actually capitalize one? So if you run from inventory to your dollar for dollar, or do you actually capitalize some of the fees that you put into the contracts?
I mean, everyone does it a little bit differently, but generally dollar for dollar for all in costs that you have in that vehicle, right? And so, then we're recording over time our depreciation against that for the slow kind of release of the value of your vehicle into the P&L. And so, on the buy here, pay here side, of course, we have, rather than those leased vehicles, we have our retail installment notes or capital leases if you're doing a capital lease, which, utilizing the RFC would generate a discount or reserve against those, kind of mimicking our fair value of those notes. And so, other things you might see in your balance sheet kind of moving forward here, a prepaid or other asset account. You pay for insurance in December for a year's worth of premiums. Well, you would recognize that ratably over the 12 months into your P&L. Who here has ever borrowed money from their business or lent a family member some money? I'm guessing plenty of us have. And so that you have a balance recorded on your balance sheet, due from owner or due from a related party. And then, of course, any other property or equipment you have in the business, you put in your assets and record depreciation against it. So those are your assets. On the liability side, you're going to find things like your accounts payable. Go ahead.
Is there something about the asset? I just want to make sure I'm clear. It's a standard, if you have a $12,000 car, you can have it's a 60-month depreciation for
60 months is one I see often, but it is really, it really should be based on the vehicle you're putting on the road. If you're putting a 2012 vehicle on the road, 60 months is probably too long, right? That vehicle doesn't have a life of 5 more years.
Mine are a little bit more expensive than this one, but if I have a 60-month, just so I understand the math, 60-month depreciation, $200 a month. I sell it at the end of the year, we get the bonus depreciation. So I've already depreciated 10 months at $200 a month, $2,000. The bonus depreciation allows me to write off the extra 10 for tax purposes at the end of the year, and then that asset that is now zero. Whenever I sell a vehicle, it's all picked up. It's all picked up in
Right, for tax purposes. Correct.
What's recorded on the financials that are submitted to us, or the monthly financials, is going to be a little bit different number, but for tax purposes, yes. So and I think that kind of goes into some of the things. So when I'm looking at a new dealer or I'm looking at existing dealers, like we're getting the monthly financials, so we're seeing month over month the changes. If we've made a change, if we go with the locations, we start to see things, a little bit higher increases in certain accounts. We are actually, on my team, we actually match it back to DMS reports. So when JP mentioned about inventory costs and refunds up, we're actually pulling DMS reports out of your system to see, okay, the number you have on your balance sheet, is it realistic to what's in your DMS system, especially if you're using a separate accounting system and a separate DMS system. We kind of balance back to that number as well. We do look at the depreciation numbers. We do look, we get tax returns in. There's a whole different kind of mindset for me when I'm looking at a tax return compared to like the internal financials we're getting. And then one of the things we didn't touch yet is at the end of the year or so, some of our, depending on the size of your dealership, we may require an audited financial from an independent CPA firm. We may require review financials. For the most part, everybody's required to do at least a compiled CPA financial. And what that does is that puts the independents with another company coming in and looking at your financials and your books and stuff, and it gives us another look into those financials. Personally, I know a lot of you get the email from Trevor asking for your personal financial statements. So we also do look at where you are personally from a guarantor standpoint, but the money that you're taking out, the distributions and stuff, what does that look like as your personal? Are you saving it? Or are there things that you're doing with it? And we do look at bank statements at the beginning of a relationship. It's not something that I ask for once we kind of have the deal done and we are closed and you're funding normal. I don't usually ask for bank statements. If I do, there's usually a reason why we're asking for them, but for the most part, that's not something I get after we've already closed.
Yeah, thanks, Kelly. And We did kind of touch on the second question, what financial statements are requested for new potential ongoing borrowers. Is there anything else you want to add there? Or?
No, I think we're clear. I'm just watching our time. We're keeping you from lunch.
Yeah,
So as soon as I start hearing stomachs growling, I will pause really bad, or mine starts, but I think we have one more little couple of questions we wanted to just kind of get to. But does anyone have any questions, any other things? I mean, we're trying to, like, so it's supposed to be informational as well to help you. This is a fictitious borrower, so this is not reflective of anybody at all. And if I start to see financials that look like this, I'll know where you got it from.
Don't fill in your numbers and turn it back in.
So I think one of the questions we had was some of the biggest challenges.
Really quick.
Okay.
Nick, did you have a question?
Kind of want to touch on the bonus.
Yeah.
It makes me super nervous, you know, and I just, because I just know there's there's an inevitable tax liability out there. And I'm just wondering if you have any suggestions on, you know, bonus, it's, you know, it's going to expire in 2023, and one guy told me it's like a tax-free, it's like a 0% interest loan from the government. It's kind of how I look at that bonus. But, I mean, if it's starting to get really big, should you continue to do bonus, or should you just start, like you said, biting the bullet?
It's a great question, and there's an individual answer for everyone on that. And I guess the saving grace is, you know, it tapers off, right? So it doesn't go from, you know, 100 to 0 overnight. It goes to 80, and so it gives us a little bit of time to work into being a taxpayer again. But I mean, this is maybe the price we pay for all the benefit we've gotten. And there's going to be a careful strategy involved, Nick, and we might have a different administration by that time. And there will be powerful lobbyists, as we talked about in the room, fighting for us. So.
But it's definitely a conversation now that most 2020 tax returns are done, most are done. It's definitely a conversation to start considering what is your 2021 going to look like, especially when you start hopefully ramping up an inventory and getting into a normal maybe tax season next year, maybe. But it's not a bad time to start planning that. The other thing, just to plug in every time I see you, the other thing too is a lot of times your estate planning is going to play into that too. So I know we're not specifically on our agenda here, but while you're talking about what are you going to do from a tax with depreciation, also look at while you're having that conversation, have your estate conversation. What does that estate planning look like with your dealerships, with your companies, your succession plans? Because that might ultimately be part of that decision too, as a whole. Tim, did you have a question or?
Yes, no, I did. In my mind, if I'm thinking about deferred tax liability building up, and there's the potential for me as a dealer to start to build up my reinsurance program, is that a potential strategy to offset the future tax liability at a time when you can deploy it really whenever?
I think it is. You know, if we can generate more loss, or for lack of a better word, hide a little bit more income today, worry about it tomorrow. You know, park it in reinsurance. Brett and I were talking about this earlier. Park it in reinsurance, and yeah, you may have seen the news that Biden's plan came out 2 or 3 days ago, and it really wasn't as harsh as we thought, but it involved potential capital gains hike from 20 to 25. And that's what we pay when we liquidate our reinsurance. We take distributions out of reinsurance. And so taking more money to park there and dealing with that implication down the road at the right time with the right administration is certainly in play.
Yeah, thank you. Johnny, it's you.
Just to add to some of the responses to the next questions, I look at depreciation. I think there are two pieces to it. There's a permanent part of the depreciation and there's a timing part of the depreciation. On the permanent part, I would say to everybody, if you can take the bonus depreciation and you can take it now, unless rates are going up and you want to take it in the future years. So there's got to be some planning around that. But in general, taking the bonus depreciation, especially on the permanent side, makes sense to me. The second part of it on the timing side, which means when you sell the vehicle and you're going to recapture some of that depreciation, I would say that part of it is that money be careful about how you use that money, because you're eventually going to have to pay the taxes. So I look at it in the two buckets, the permanent piece, the timing piece, and on the timing piece, make sure you're putting aside that money to know that eventually that liability will come through. I think one of the other questions that comes through in my mind, in terms you touched on, which is, so that's one tax strategy, is a question of looking at the other tax strategies. How do you set up your entities, and what other tax strategies are available now and going forward to be able to reduce your income.
Excellent, thank you for that input, Johnny. So what I'm gathering is there's a lot of thought that should go into tax planning and tax strategy down the road. Are there any other questions that we missed? Here in the front.
Well, that is potential, but there are also a lot of other programs, a lot of other reinsurable products, right, that you can send profit over the reinsurance company. And you know, another reinsurance company could be open. I think maybe the ownership has to be a little bit different to take advantage of the, so like 2.2 million premiums. Is it up to four? Up to four? Okay. Per year, so. No, it wouldn't be. It's a business decision that I think is defendable, and yeah, in theory, I don't know. Have to put a little more thought to this, but you know, you can generate more loss that can be utilized for the future.
But the caveat to that, as JP mentioned, though, is if the capital gains taxes do go up, when you bring that money back, quote, onshore, you're going to be paying a little bit more tax. So it's a strategy of how much to deploy to the insurance company versus what you're going to pay coming back in. So it's kind of got to be looked at kind of holistically, but also knowing the administration's change over the 4 years in those cases.
Yeah, but even on top of that, I mean, we can park that money over there in reinsurance and advance it right back over to our company as a loan, right? And deal with that tax.
Coordination so that I can count it as
There you
equity.
go. And deal with it at a future date down the road, right? So you don't have to worry about the 20 to 25% capital gains.
Yeah, thank you for those thoughts on reinsurance. I know we have a couple questions coming in by text from Kevin.
Yes, we do. Okay, so do you have any insight as to how we continue to educate the markets regarding the LHPH model? Clearly it works, but there still appears to be barriers to the market because the run-of-the-mill banks either don't understand or don't want to learn to understand. So any insight as to how we continue to educate the markets on the LHPH model?
Good question. Well, they can attend the summit.
You guys hire more LHPH. Get out in the market.
How about the other trainers?
We learned a little bit about that NIDA, so Bill said dealer 20 group for all of this. Those are an excellent opportunity to learn about LHPH.
But if you're going to directly ask me, how do I get lenders at banks to do LHPH a little bit more than that, I talked to Nick last night a little bit. It's a mindset. So knowing what we've gone through with our bank partner and having worked for 3 different banks and specialty finance groups, I hate to say that auto scares people. Consumer scares people in banks sometimes just because of the compliance that we all heard about this morning. A lot of it is the pressures that some of the OCC and the regulators of the banks put on it. So your fintechs like LHPH and your other fintechs that can do it, that's going to be more of the avenue that I've seen, and then letting us be able to get that financing. But what I've learned over my history is just that it depends on the credit officer at the bank, what their tolerance level is. So how do I educate them more? I mean, honestly, we're doing all of our social media stuff, all of our blogs, and that's been the biggest component, is just getting that information in front of people the best we can. But if you hear LHPH, you hear buy your bigger, the same kind of context, some people actually just run. So it's a little bit different mindset. And I'm not talking just auto. I've seen buy your bigger furniture companies that are incredible, especially some of the publicly traded ones that I've linked to. And the tactics are different, not much different than auto, but the concepts are still there, so people just, get a little scared with it as far as a credit officer goes, that's no offense. Which is why fintech exists, because the regulation's a little bit smaller.
Yeah, thank you for that insight, Kelly. I know we are getting close to lunch, so we have a few more minutes though. So why don't we go ahead and move forward and let's talk about what are the biggest challenges dealers face in producing regular financial statements.
Can I just say one other thing on the financing subject and the prevalence of LHPH and understanding it? I think that, there aren't many folks lining up to lend to the biker paper space either. And I think if you're a very good operator with some history and maybe a little bit less risky balance sheet, a little bit less leveraged balance sheet, you will have options and avenues. I think the world of LHPH and their program, and no one understands it like they do, works with it like they do. But I just think that if you're a strong dealer with history, then it doesn't necessarily matter if you're biker payer or leaser payer. So.
Perfect, thank you, JP. So, going back to the biggest challenges facing dealers face in producing regular financial statements, can you give a little insight on that as well?
Absolutely. We've got some points to share. So I think, first and foremost for me, as you're approaching this, is ensuring that your DMS kind of software solution that you choose, within it you have a plan for accounting. There's varying levels of products out there, built-in, integrated, or non-existent. So don't wait 6 months down the road realizing you have a mess on your hands, right? As you're planning this out, think about what product you're getting for accounting and what your plan is to complement it with people or other kind of software modules. So that's one for me.
Yeah, I would say that's my biggest one. I think the other thing is just, and I'm not going to say this, but mindset that your tax returns, which is where you gauge your success and such, and how much you have to pay in tax or what your loss looks like from a tax basis versus your actual books. It seems that sometimes what I see is that there's a little bit of a disconnect that what we need to see from a book standpoint or from a CPA kind of standpoint, it's a little different than how you measure your business. And it doesn't mean that I'm right, you're right kind of concept. It's just, there's just different ways to look at your financials. There's different ways to produce the financials. And depending on how much you trust that DMS on their defaults and their setup, just knowing what's going into your financials, where your money's going, is sort of what I see is that challenge. It's just a lot of times I'll see prospects or new dealers and I get tax returns and they're, disregarded entities, they're on your Schedule C, there's no balance sheet. And so now all of a sudden I'm coming in and Trevor's saying, okay, well, my risk person is to see a balance sheet. And that's where I think a lot of it just comes from is how you look at your business versus how a lender looks at it. And so a lot of that with Chad and JP and Marie as our controller, a lot of that's just helping you get to the point where you're comfortable, not only with your profit and loss, but also with your balance sheet. Where is your capital? What is the enterprise value of your dealership? What does it look like to you?
Awesome, thank you, Kelly. And I think we're just about out of time, and I don't want